Good morning, my name is Fletch Heinemann. I'm a partner at Cooper Grace Ward specialising in tax and tax disputes. With respect to income from overseas, the general rule is that Australian tax residents will need to include all amounts of their income, whether from sources in Australia or from overseas, in their assessable income. There are different rules if you are in Australia at the moment, but are technically a non-resident, and there are also different rules if you are a temporary resident. However, both of these categories are quite complicated. It's important that you don't assume that you are either a temporary resident or non-resident without working through those tests. We have seen a number of people come forward and say that they missed the Project Do It amnesty in 2014. That amnesty allowed people to make disclosures to the ATO of foreign source income that they hadn't included in their income tax returns over many years. Some of the clients who have explained that they missed that Project Do It amnesty were overseas at the time, in which case that then raises a question as to whether or not they were actually Australian tax residents for that whole period. If somebody is an Australian tax resident and has missed that Project Do It amnesty, then there is still scope to make a voluntary disclosure to the ATO. Making a voluntary disclosure in those circumstances is the best way to look at reducing the administrative penalties that the ATO can impose. There is a real advantage in making a voluntary disclosure at the moment, as the ATO is getting information from foreign tax authorities and also foreign banks. So we're expecting that the audit activity in this area is increasing significantly from the end of this year. So there is certainly still an opportunity to make a voluntary disclosure to the ATO before they get that information and start an audit. Our experience is that once the ATO has started audit activity and no voluntary disclosure has been made, it's then very difficult to try and get a reduction in any administrative penalties. There may be certain amounts that a taxpayer has earned from overseas that aren't subject to tax. This typically happens when a taxpayer has been living and working overseas for a period of time, sometimes as an Australian expat, in which case there is then an issue to figure out whether those amounts are subject to tax in Australia. If you are an Australian tax resident, you need to include all amounts of income in your assessable income, and that includes from Australian sources and overseas sources. If the amounts have been taxed overseas, then there is then a possibility that the Australian Taxation Office will need to give you a foreign income tax offset or a foreign tax credit that counteracts the amount of tax that you paid overseas. So essentially you shouldn't be taxed twice on the same amounts. However, depending on where the income is earned, there may still be top-up tax to pay. For example, if the income overseas has been taxed at a fairly low rate and it needs to be included in your assessable income at the Australian resident rates, then often there will be some top-up tax to pay, even including that foreign income tax offset. The important part with foreign tax credits is to make sure that you've got evidence of the tax being paid overseas. Thanks for watching. If you have any questions, please feel free to contact us. We're always happy to help where we can.